You might be able to hear me now. I do apologize. We've been having a couple of changes here this morning, but welcome traders and investors to the TA Live Wednesday live stream show. I'm your host, Bennett Tyndall, tradinganalysis.com. We do apologize for a little bit of the technical difficulties to get started there, but hey, welcome and thank you guys for taking time out of your morning. So as you can see, bottom left-hand corner of your screen, S&P futures did push lower this morning. We're bouncing back kind of into yesterday's closing range. The volatility does continue, and the December distribution video, if you caught that, it appears to be aging well. We talked about the possibility that instead of seeing the traditional seasonal rally into the end of December and January, that perhaps we were up against a wave 4 correction. That wave 4 correction does appear to still be underway. We were discussing last week the possibility that we respected the support structure of the correction, and we're actually inking out the low last Monday. The NASDAQ didn't break last Monday's low. We got really close, but the S&P did break lower. So looking at that, still as a wave 4 position, we've got a good show. We'll get to the charts in just a few minutes. We also have a webinar event this afternoon we'll talk to you about as well. We do have a special guest, founder, former CEO of Trading Analysis, now CEO of Insight Edge Capital Management, Mr. Todd Gordon will be joining us from the Advisors Corner. So before we get into the charts, let's go ahead and welcome everybody, bring in the team. Good morning, gentlemen. How are you guys doing today?
Hey, guys. Good morning.
Morning.
What's happening?
Good to see you, Todd.
Hey.
Nice to be back with you guys. Sorry, all the audio and delay. That was all my fault. Sorry, Ben.
No, not at all.
I'm just checking back in. I got to make sure you guys are staying on your toes. Gotta, shake it up, kind of stress test it. No kidding.
Absolutely.
Sorry.
Good morning, Terry. Good morning, Alex. Alex, you've got a webinar this afternoon. We'll be talking to traders about that in just a bit. Welcome. How are things in your neck of the woods?
Yeah, it's a pretty nasty here in regards of Omicron spread as everywhere in the world. So yeah. It's like a small country. We're 6 million people, but it's a mild one. So I guess I talked about that with Todd. I think this is the probably last variant. So hopefully we will be out of this soon.
That's the goal. That's the goal. Yeah. That's definitely the goal. So traders, we appreciate you guys tuning in once again. We're going to jump into the Advisors Corner, pass the screen off to Todd. Todd, how are you doing today? Doing well?
I'm good, man. You know what? Good, Bennett. Hey, why don't you take it first? Why don't you set us up
sure.
in your normal routine, and then bring me in after. I want to follow kind of what you're doing in the wave counts first, and then I'll slide in behind you.
All right, sounds good. Let's jump over to the MotiveWave platform, take a look at the indexes. We'll be back on the other side. Catch you guys in a few minutes. All right, good morning once again, and welcome. Thank you guys for tuning in. Let's jump into it. Hard right edge of the MotiveWave platform. This is one of 2 key tools we utilize here at Trading Analysis. So looking at, first, I'm going to take you to the NASDAQ. We're going to take a look at the chart of the NASDAQ 100, and I'm going to pop this back all the way out to the daily time frame. We're going to start on the daily. We're going to discuss the upside progression that we've seen from the COVID low. And as we looked at last week, we continue to view this as a wave 4 correction pairing up to the wave 2 pullback in September of 2020. Looking at this correction, we discussed last week the possibility that we were actually finding support into last Monday. Last Monday's support level was at a very appropriate fib relationship to the corrective structure itself. But as we discussed, if we look to the actual wave 4 position that this correction occupies, those support levels were actually down near the October lows. So we knew there was still a possibility. We did push lower down to those October lows. Let's get off of the daily and let's take you in to the upper right-hand corner of the screen. We're just going to focus in on price action off of that November high from the daily down to the 195-minute time frame, looking at price action in the NASDAQ. Now, with the move up in yields, a lot of traders have been wondering if, in fact, this is the start of a larger, perhaps bear market or 20% market correction. We continue to view this simply as a garden variety counter trend correction prior to resolving higher on the upside. If you look at the November 22nd high, price action from the November 22nd high unfolded in a corrective structure, in a corrective manner. If that were truly a wave 5 position of a higher degree, or even a wave 5 position of an intermediate or minor degree, you would anticipate a directional motive wave from that November 22nd extreme. If in fact I'm wrong on that swing point and the anchoring is actually into the December 28th high, that would, number one, make for truncation. But number two, we would have completed in a three-wave structure, which three waves does not complete a trend. So looking at this now, we have 3 down, 3 back. It's been a fairly complex structure. We looked at the possibility that the 5-wave decline into January 10th actually was wave C of a 335 Elliott Wave flat correction. For those of you who are new to Elliott, it's essentially the differences between 3 or 5 wave subdivisions. So don't get glassy-eyed. It's a fairly straightforward concept to kind of digest. So in fact, going into last Monday when we had that gap lower, we had anticipated a push lower with our clients, picked up a position Monday in Microsoft, took advantage of that rally, captured about 50% over 2 days on an options trade for the bounce. What this is proved to be, in my opinion, is simply wave B of an overall 3-wave structure, meaning we just did another 5-wave move down and we're looking at a 3-wave retracement to kind of confirm that decline. And that should take us down into fib support. Downside fib support is offered from wave 4 equality to its wave 2 counterpart. That comes in at 14,390. Interestingly enough, if you were to take your C wave and look at this measurement compared to the A wave, which for those of you in the world of technical analysis is referred to as a measured move. So if you were to take the magnitude of this decline, project it from your B wave retracement, which by the way, the B wave retracement was a spot on 618, and look for equality, you'll notice equality comes in at 14,626.93. Looking at that 4V2 objective or downside support, the equality measurement comes in at 14,390. And simply put, this means wave 4 would be equal to its wave 2 counterpart from September of 2020. We all know corrections of the same degree do tend towards equality. So the idea that we visit that downside support is not lost on me and is certainly something I'm looking for after yesterday's price action. So here we are in the NASDAQ. Now, could this still be a flat and we unfold in 5 waves? Sure, but you're going to see a very similar fib support cluster. Now back out to the daily, I had a comment on a public update I did last week regarding the validity of Orange Wave 3, and the question was, is there in fact overlap between our waves 4 and our wave 2 position? There is in fact not overlap, as you can see here. The low of wave 4, 12,208 spot 40 versus 12,204.80. So it was 4 points away from overlapping that particular wave 1 high. Now what I love about this particular wave count is the fact that this is my preferred approach, because this approach has confluence with other major market indexes, with small caps, with mid caps, with various industry group counts. But I replied to that particular comment and said, you know, while I completely agree with the fact you typically don't have corrections of the same degree that close, typically you have isolation, like you see here in the blue or the green minor degree structure. I said, even if I'm wrong on this being Orange Wave 4, that simply means everything moves over one swing point to the right, and that makes for an even more bullish outlook. So I'm not I'm not bearish. I continue to remain bullish and view this as an entry opportunity. Let's go over to the S&P 500. Looking at the S&P 500, I'm tracking this as well as a wave 4 position, pairing up to the wave 2 correction from 2020. And here in the S&P 500, I still have this labeled as a flat. So this is a great opportunity to kind of illustrate the differences. So with the WXY, which is essentially a string of 3-wave corrections that I had in the NASDAQ, here in the S&P, I currently have it labeled as a flat, meaning down in A, 3 waves back in B, now looking for 1, 2, 3, 4, 5 waves down in C. We've got a very similar zone of support, and what's very interesting about this support zone is if I bring in a very common Elliott Wave channeling technique, which is taking the anchoring of wave 1, drawing a trend line through the high of 1, through the high of 3, and then projecting your parallel trend line through the bottom of 2. You do this when you have waves 1, 2, and 3 complete, and you're looking for that wave 4 support zone. I can ask MotiveWave to do this. MotiveWave has the Elliott Wave logic built in. It understands the channeling techniques associated with MotiveWaves. And here it is, 1 through 3 projected over the completion of 2. If you look at this downside trend line support and look where 4v2 equality comes in, 4v2 equality takes you more or less to that downside channel support. Also, when looking at this in terms of the corrective structure, a very common C versus B relationship is a 1-2-7-2 external retracement. So this gives us a zone of support, number 1, offered from 2 degrees of trend. We have our C wave correction and we have our wave 4 overall correction, which is what the structure fits in. And then we have the previous 4th of 1 lesser degree. All of this gives me a high conviction support cluster between 42.75 up to 44.10. That's where I think the S&P 500 has a chance for reversal on the upside. We continue in to finish wave 5, and that's where perhaps we are up against a larger market correction. But again, remember the fact that I've taken you through this exercise reviewing the higher degree structures off of the credit crisis lows. Those corrections are typically nothing to really stress over, and really depending on your outlook and your time frame, should be something you should take advantage of as an investor. So that's it for me. That's my current view on the markets. Looking at the Russell 2000, we had a question regarding the Russell 2000. Here we were discussing the idea that we were in a wave 4 position, pairing up to wave 2. It does look like we're going to push through those lows. That simply means we're in a more directional wave 4 structure. And what I really like about this small caps chart is the fact that in the corrective move, 5 down of A, 3 of B, projecting a quality of C and A takes you right to our 38.2% fib retracement. So that's it for me. We're going to go ahead and leave it there. We'll go ahead and jump back over to the team. As you can see, markets are off the low. 45.35 S&P futures low back to 45.89. What do you think, boys?
Great work as always, Bennett.
I appreciate it. I appreciate it.
It's it's interesting here. A lot of fear. You know, a lot of the collective narrative out there is overly bullish, and when you get into this kind of work and really roll your sleeves up with the technicals and just take an objective stand, step back, it kind of puts everything in context and say, wait, are people getting a little too over their skis with all the fundamental and macro reasons why the market should sell off? And then you actually take a step back and look at what is happening. And that's, how a prudent trader and investor behaves. It's not IQ, emotional intelligence. Sorry, it's not IQ, it's EQ, which is emotional intelligence to kind of control the emotions. And that's what Ben is doing with all those in-depth facts and figures in Elliott Wave. So I don't know, just pulling it back, but great job as always, Bennett.
Very good, much appreciated, Todd. Yeah, it's been a little bit of a challenging market off the sideways November 22nd highs. Not something we didn't anticipate. Curious to see where this resolves. Let's get the screen share set up. We're going to take you over to the advisor's corner. All right, Todd, you ready to hit it?
Sure. Let's do it.
All right, take it away. We'll be back on the other side and then take you into sector focus and, of course, macro with Alex.
CBC very quickly, and also live stream. So, can't hear me.
Can't hear when we switch to that other page there. Now we lost Bennett too.
My fault. Can you hear me, Terry?
Yeah, I can hear.
Okay.
Say something.
Yeah. You're good to go.
Yep.
All right, take it away.
Okay. All right. Hey, again, good work, Bennett. I really threw a wrench in the works here this morning. So All right, so thanks again for having me, guys. Crazy market, lots going on here, inflation readings and this whole debate about inflation and rates spiking, and everyone's talking about the big sell-off in the market. And as I was saying, let's kind of take a step back and really look at what's happening. And this is why, as I've transitioned to be a wealth manager, from the days of trade analysis, and this is always going to be, my baby and the first business I started. And this is our 10th year in business at trade analysis. Like, can you believe it? We started in 2012. So, it's as it evolved, I'm always going to be, a technician, always going to have a feeling and understanding of what's happening on the charts. And then, as I'm moving into managing, millions and millions and millions of dollars, what you have to go a little bit more mainstream. And I think as I've gone more mainstream in the last 5 to, call it 5 years of my investing, speaking a more traditional fundamental language, I find that it really helps to understand what the collective thought is around the fundamentals that should be driving the market in the charts and what's actually happening. Sometimes they agree, sometimes they disagree. And it's important to understand that. And I hear, a lot of cause, a lot of fear, a lot of concern. And I think, is there any cause for that? And if you just take a step back and say, all right, what is actually happening in the NASDAQ? Here's the monthly from the COVID lows. I think we're up like 125% from the lows. This is the monthly candle that we've seen so far in January. It is not unlike anything really, it's a little larger here than August, but we saw 2 down months even prior to the COVID, just following the COVID lows. We had some volatility in 2018, and I want to show you sort of the interest rate scenario there. But as you kind of squeeze out and realize just the strength of the trend that we've been in, coming out of the credit crisis, it's important to keep this all in perspective. So, getting down into the wave counts here a little bit, I think it'll further prove or show, according to Elliott, which again, if you're an investor or if you are a trader who's new to Elliott, it's very much an esoteric language. I get it. If you spend some time, you open your mind, you'll see the market respond or respect turning points that are just mind-blowing. It'll change the way you look at markets forever. It's not for everyone. Some people don't have an open enough mind to view it. People need it more objective. A plus B equals C. Well, that's just not reality in the markets, whether you're doing technical analysis or fundamental analysis. So I kind of keep my own wave count on top of what the guys are doing. I still plug into the Motive Wave system. Guys are doing red, green, and blue count, and I think I am more aligning with Bennett's green count. And here's one of the main reasons to put my Elliott Wave hat back on. The post-COVID low, okay, the first and the largest correction that we've seen post-March 2020 was this guy right here in September, okay, of 20. That was the largest percent drop. That in and of itself should suggest that this is the first major correction. Everything that we've seen following that has been smaller, okay? And that kind of suggests to me that we have not seen the wave 3. The second reason, okay, completion. We haven't seen the wave 3 completion. The second reason is look at the fib projection. Net percent distance traveled here, projected up. We got through the 61% relationship, okay? That's the first sort of less than equality fib target you look for. We respected it here in SEP of 21. Rallied up, and now we're actually using it almost as support. I still can't help but think we're going to have 100% up here, at least to go in wave 3. The other reason is, guys, when you have a wave 2 is traditionally at least 50% retracement of the preceding trend wave. So it should be 50, even better at 61.8, and 78 is a deep one, but still valid. All this guy could do is manage a 23%. It's unusual, but it indicates there's a ton of relative strength. So that means there's a ton of strength or momentum in this market. So that means I think it's premature to cap and put this wave 3 here or here because we're not even at a quality yet. And typically a wave 3 should go at least as long as wave 1. So I think we have to embrace sort of the fractal nature of Elliott. And going into what Bennett was saying here, you can count blue 1 and 2, 3. I think we're doing 4. You know, I don't like the pullback that I've seen in our growth portfolio at Inside Edge. I'll show you the allocations. We do actually have a pretty unusual growth portfolio now because it's the nature of the market, which is we have an overweight in energy and financials and materials, and that's pretty unusual. You know, guys, if you've been trading, you know, with me at Trading Analysis, you know, when I was active over the last 2 years and all the way back to 2012, you guys know I've always showed you my longer term portfolio, which I was super long, AMD and NVIDIA, XLK, QQQ. Like I've been riding this tech bubble from the beginning, and I've begun to take profits, and I had to do some tax work at the end of the year to move my money into the wealth management. I had to take some of my tech off, but point is, this is a different kind of market here where you needed to be in financials and energy, even if you're more of a growth-oriented investor. What Bennett was saying earlier is if this is accurate and we're going to begin to look for support here in the NASDAQ, it might be time to rotate back in. And this is right at the time when yields are spiking, 10-year yields above 1.8, financials are leading. We'll talk about Morgan Stanley just came out with earnings. Goldman was out 2 days ago, not so good, but Morgan earnings were very, very solid. We talked about that on CNBC yesterday. I did a whole bit on it. Morgan's a big holding in our portfolio, in our value portfolio as well. But it might be time to rotate, okay? So let's just take a look at this real quick, kind of get off the technicals, and let me just get the questions and comments up. Interesting, Andrew P. I see what you're saying there. I'm very bullish. I'm very bullish on this market, and you know, I'm not the way I ran Trading Analysis and the way I'm running my money management business is we are not a long only, like mandated, always in the market, always bullish. We could go to cash. I could put option hedges on for our clients. We have the ability to do that. We have the freedom as the way this business is structured to do that. I'm not doing that now. Okay, I think we're still have a long way to go on the upside. But if and when the time comes to get protective based on what the wave count and the fundamentals and the sentiment suggest to us, I will absolutely do that. Okay, but the fact that we might have our first interest rate hike is certainly no reason to be bearish. So let's just go back and look at some history here. I think it's really, really important. And I saw some misleading stats on the internet and said, oh, we have a huge rally to go because we saw the beginning of an interest rate hiking cycle all the way back to 2008. Well, let's just take a look at the history. This is a really nice page available on Wikipedia. Just a nice visual depiction of it. So we went from 0 to a quarter, 2008, did in 2011, 0 to a quarter. Finally, in 2015, they hiked once. So they went from a quarter to 50 basis point target federal funds, waited a whole year, then went to 50. Then in 2017 is when the rate hike cycle began. Okay, so 75, so that's hike 1 in 17. There's 1% hike 2 in 17. 1.25 is hike 3 in 17. Then we went to 18. Okay, so then we hiked once in March, twice again, second time in June, third time in September, fourth time in December. And then this is a funny annotation. This is when Trump was hammering on Jerome Powell for hiking too quickly. And then we started to back off 2.25, 175. Then, of course, COVID hit, we slashed right down. So I think it's important to look back and say, what has the market done after our first two little isolated hikes in 15 and 16, and then 17 all the way up into 18? And before I move on from this, guys, I don't care if you're an investor or trader, everything you're talking about, my approach to investments in portfolio selection and trading, it's all the same. The process that I developed over the years, over my 20 years as a trader, has always been sort of bottom up, okay, bottoms up. So we have global macro, that you look at the fundamentals, you look at sector rotation, you look at sector and industry groups, you look at the sectors and industries that are leading the broader averages, then you break it down to the companies, you do fundamentals and technical analysis on those, and then at the top, you reach a stock that you'd like to trade or invest in. I think the process is the same. So as I'm getting off in this, guys, to be a complete trader and investor, I think you really need to understand the technicals. You need to understand the fundamentals. This is a game, there's trillions of dollars sloshing around here. You're dealing with the smartest minds. And if you're looking for a simple A plus B equals C system to go make your millions of dollars and you can quit your job, it's not going to be that easy. Okay. All right, so let's get off that real quick. I don't want to take too much time, but let me flip over to this guy right here. This is a cool little chart on stockcharts.com. I've always liked this guy. It's a dynamic yield curve chart. And back to my prior point, again, I don't care if you're a short-term trader or position trader, swing trader, investment time frame, you have to understand this stuff, okay? So this is the yield curve. Okay, this is everyone's talking about this. Everyone's focused on the yield curve, and basically what you're doing is you're looking at the yields at different duration maturities of U.S. Treasuries. So 3-month, 2-year, 5, 7, 10s, 20s, 30s. A normal shaped yield curve, guys, is like this. Is when short-term rates are low, longer-term rates are high. That's good for financials, which is very interesting in here because financials are doing so well. Okay, it's when you start to get shorter-term rates that are at longer term, at the same levels as longer term, that's when you start to get something called yield curve inversion. Okay, so a perfectly shaped yield curve is like that. Okay, steep. But what happens is at significant market turning points, like here we go in 2000, look, the Fed was hiking rates, which is going to impact the shorter end of the yield curve. The federal funds rate will impact this area of the yield curve, not here. So when you start, the Fed has to raise rates to cool off the economy, pushing short-term rates above long-term rates. That's what sets up this kind of sell-off. Okay, and then the Fed cut rates to engineer a steep yield curve. Same thing happens here in 2006. Look at that yield curve inversion. Boom, flat, almost inversion there. Credit crisis. Fed slashes rates. So here we go again. Okay, so here we go again. And what you'll notice is even though the Fed started hiking rates in 2017 and 18, I think it was 7 total times in 2017 and 18. Let me see if I can zoom in on this a little bit here. That's not going to work. That's okay. Even though the Fed started hiking rates, we got a little bit of volatility here. Okay, little bit of volatility, but look at the stock market is still going up. Okay, so we started the real hiking cycle here in March of 17. Look what the S&P did. It's moving higher as the short end of the curve is moving up, adjusting to the new federal funds rates levels. But then COVID hit and boom, it just got hammered. So we were hiking already in 2017 and 18 in a strong economy. The pandemic hit and we had to start over. The point I'm making here, guys, is the yield curve, even though rates are moving up at the long end, you're getting a 1.8% 10-year yield, which is right about here. You get a little higher at the 30-year. This is not an inverted yield curve. This is a healthy shaped yield curve. Even if the Fed hikes 4 times in 22, that's going to put you like right here. Okay, and if longer term rates want to go up, it's not as steep of a yield curve as you'd like in a recovery or early phases of a bull market, but this yield curve looks nothing like it did here or here. Okay, so I think we need to really kind of say, all right, let's take a step back here. Added to that is everyone's concerned about inflation. And I don't like crude oil going up. Crude oil right now is trading 86.22, up another percent. I don't like this idea. Goldman came out and said something yesterday and said, well, usually the Fed is hiking rates when the economy is too overheated, which I think, we do have a very strong economy here, but it's more of inflation driving the need to sort of tighten monetary policy, crude going up. There's whiffs of stagflation here, which is prices moving up with flat growth. That could be problematic. But I go back to this TIPS, this 5-year TIPS Treasury break even. This is where the bond market is pricing inflation expectations over the next 5 years. And if you look at this, we've come from basically zero, a year ago, no inflation. Now we're starting to move up. But just look recently in the last month, we've come off quite a bit. Inflation is expectations as not making new highs with crude oil going up. And this all goes back to supply chain. This goes back to reduced Fed stimulus or government stimulus in the pandemic era. This chart for me, being that we're well off the highs, we made another push up, started to roll back over. This says that the market is not as afraid of inflation as I think the prevailing they out there, which is media, which is everyone you listen to on YouTube and blah, blah, it has you believe. It's a good scare story, but look at this. This is 10-year TIPS break even. Made a high, sold off, rallied to a lower high, starting to push lower. I'm not overly concerned here, guys. So I think it goes back to the point on the NASDAQ chart. Here's where I'll show you my growth portfolio for the wealth management business right here. We are pretty overweight some unusual sectors that wouldn't normally be the case in a growth portfolio that I would have put together 5 years ago. So for instance, energy in a growth portfolio, 14% weighting compared to the S&P at a 3% weighting. Massive overweight there in energy. Materials, we're at 6 and change right there. Materials here it's pretty far away here. Where's my materials? I'm going blind as I'm getting older here, staring at, am I insane right now? Oh, it's at the top.
It's at the top.
2.25. Yeah, thanks. This screen is a little far away, Terry. I might need some stronger glasses.
You're getting
materials.
old. Admit it.
I got this new setup, man. It's cool. Like I can look at the camera behind and kind of do presentations, but the resolution is very small. I'm gonna have to work on that. But so energy at 14%, materials 3, materials 2 right there. Consumer cyclical we're double weight there, 23% compared to 12%. Financials were market weight at 12% compared to the market at 13 and change. But again, this is a growth portfolio. Shouldn't normally have that much in financials. So it's been a great close to the year here in the growth. But what I would say is back to the point that Bennett was making earlier. It's important to put the technicals in front of what everyone says should be happening. And what that is everyone's saying rates are spiking, inflation's out of control, tech's going to drop 50%. Guys, just take a step back, and I'm going to stop here right now. If you know anything about markets, anything about Elliott, anything about how markets actually reverse, this is a very clear three-wave structure. The way corrections go complex is if the three-wave correction didn't satisfy price and time requirements from the prior motive wave, it morphs into something larger, which becomes the X wave, and then you go into another three-wave move. Very common, but this looks very corrective to me. So I hate seeing the NASDAQ down 9% or whatever from the highs, but again, you look at where we've been since March of 20, or even from the credit crisis, this is a blip. This is nothing. Okay, so I'm bullish. And if we start to see the NASDAQ respond, and watching Terry's sector work, we start to rotate back into some of the tech sectors and industries that have done so well, you can be sure I'm going to be rebalancing and sort of realigning that growth portfolio. Huge webinar coming up. Web 3.0 is amazing. It's all I hear about. This move up in rates and this inflation scare, I think, is a blip in what's otherwise a longer term tech bubble. I can't believe I just said that. It's a Freudian slip. I'm afraid too many people are thinking it's a bubble. It's a bull market.
Todd, I think your audio input, your phone just died on you.
You guys are talking about looking at the right sectors and industries, looking at the technicals and understanding the fundamentals. I think that's the only way to be a complete trader in this investor in this market. So, guys, I'll turn it back to you. Thanks for letting me hop in. And last thing is we have an exciting rebranding, name change. As I brought a partner on, he's awesome in the wealth management business. So we have a new name that's coming out here, should be this week, that reflects both of our values, and hopefully it'll make the team at Trade Analysis proud, and the two businesses can exist side by side. And it's a complete, I think, offering from the guys at Trade Analysis in the short term to medium term to longer term portfolio management. It's I think it's the only way to approach these markets. So, guys, back over to you.
Much appreciated, Todd. Thank you so much for jumping in there. Yeah, very interesting to see the chart progression there in the NASDAQ. And to your point, just as we're coming into that zone of support when probably a lot of retail traders are capitulating and getting out of growth is when they should be rotating potentially back into it. So excellent work. Glad to have you join us.
Sorry to take so much time, guys. I apologize.
No, not at all.
No.
Anytime.
All good, all good. We're fully aligned. I mean, and that was a great explanation. We're going to be revisiting that dynamic yield curve as the Fed starts to raise the rates throughout the year, because that's the key thing. And certainly that's what happened in the last part of 2018, as you showed. The Fed got too slap happy, too confident with the moves they were making, and bam, 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 bam. And then, 2018, the bottom fell out. And I'm old enough to have remembered the same thing that Greenspan did back in 2000.
I remember.
Wasn't happy that the moves that he was making an impact in the market, so he made another move, and just they're going to have to take time. Market absorbs the moves, but it does take a little bit of a time. So,
especially interest rates. I mean, he just slashing rates in response to the tech bubble, which, as I said, is a much different tech market that we're in now, precipitated the housing bubble. Just cheap money flowed right into the housing market. And it's different. It may be hard to say it's different this time, looking at real estate values. But there is cheap money out there. But again, these companies that are leading the markets are making so much money. And they are having profound changes on our lives. So I hate to say this time's different, but it is a different tech bull market than 20 years ago. So, all right, guys, have a great rest of the show. I'm going to be here watching and listening.
Sounds good. We'll see you on the next one.
Okay.
All right, Mr. Terry Long, sir, you ready to jump in? Take us through Optima and take a look at sector rotation. All right. It did. We'll see how the opening goes. We'll be back on the other side. Catch you guys in a few.
hello, traders. I'm Terry Long at TradingAnalysis.com with your weekly sector focus. Now, markets remain in a corrective mood, as we've been talking about. With the markets closed on Monday, we returned to a shortened trading week where we are seeing a continuation of the corrective wave unfold. Now, looking here at last week's performance, last Monday began with a negative move early in the morning trading, only to reverse about 11 a.m. Eastern time, reverse its course, closed with gains on both Monday and Tuesday. Now, midweek saw the market stall their ascent and then decline sharply on Thursday. Friday did find some support and relief, leaving the S&P down only 0.30% for the week. The NDX had a similar behavior, but it actually held a 0.12% gain last week. Now, the energy sector was the biggest gainer last week, up nearly 6%. Now, that's following a rebound in the communications sector, up 2.2% for the week. The materials sector put in a positive 1.14%, but on the downside, we had consumer discretionary fading 1.48%, along with smaller losses in utilities and industrials. Interestingly, essentially flat performance was found in technology and healthcare sectors, with only a very slightly negative 0.1% and 0.07% returns respectively. Let's fast forward to what's happening this week. Tuesday, post-holiday trading saw a deepening of the corrective move here in the indexes. Tuesday, the S&P declined 1.84%, and the tech-heavy NDX 100 declined 2.57%. The semiconductor group of the XLK was really hard hit, down 4.47%, pulling the XLK lower by 2.4%. Let's see if I can get that over here. Where's the XLK? Yep, there we are, 2.05. We've already got the market open today. So the only positive sector that we had on Tuesday was the energy sector, bucking the broader market downtrend and rising 0.4%. I know that one there says real estate made a little bit of positive, and maybe it did after market close, after I wrote these notes. All right, so let's take a look here at the sector rotation, checking out the sector leader scoreboard. And with that nearly 6% move that we had last week, the energy sector is moving back up the list. And actually today, with today's move, you can see, I'll animate that energy. Now we have the energies actually taken back over the lead from consumer discretionary. Now, despite this deep move in consumer discretionary down into this weakening quadrant, I am on the watch for a reversal and a potential push back into the leading quadrant soon. I want to show you guys a chart of Amazon. Let me pull that up over here. I've got the I got the consumer discretionary chart here. Got a couple of things going on with my Optima right now. There we go. Get my comments. My comments are popped back in, but you can see we set an all-time high in the consumer discretionary back in November. We've been unfolding in a corrective move. Now, what I'm looking at right now, we've come into key support levels in a long-term uptrend channel. I think also this could be playing out, like Bennett says, in a flat corrective move. So somewhere in here in this region, and there's possibly another support level just below this where we could see another push lower. Otherwise, are we going to get a breakout or a breakdown? We get some kind of rapid move back here. It'll be very interesting to see how that plays out. I was promising Amazon because I was looking at that one too. Let me take a look at the Amazon chart and bring that in because I think I have some annotations here. Do that. Boop. Go back to that. Boop. There's my annotations. All right. What I'm seeing here in the Amazon is that we are actually approaching a death cross territory unless we get a bid here real soon. You see the blue is the 50-day moving average. The red is the 200-day moving average. Dotted lines are just my simple extrapolation of the direction that they're sloping right now. So we're down here. Price has actually penetrated the 200 for, since December 30th in Amazon. Basically, we've been tracing pretty low. We are now back testing this lower uptrend channel. So I'm hopeful, optimistic that we're going to find some support here. But we need to have that done. Otherwise, we're going to actually form the death cross, and that could potentially signal that, well, there's further declines happening. But if I zoom out a little bit here, we'll see that, it's been a long period of choppy overlapping behavior basically since August 2020, where Amazon has been trading in a range from 3,500 to 2,800 and back and forth. We are seeing a series of higher lows, and that's why I've got this uptrend drawn here. All right, let me flip back real quick here, go back to look at the rest of the sectors because it's not only discretionary that's interesting. Yes, we are seeing the weakness here in the technology sector. But we've got a couple of new sectors that have popped into the leading quadrant here recently. That is the real estate sector, the materials sector, and the consumer staple. They have these are your value plays, right? So technology and discretionary are weakening. They haven't moved into lagging territory. As a matter of fact, they actually have quite a ways to go before they do so. But they are in a weakened state while we have value plays in a short run here. All right, I'm going to leave it there for brevity and for time commitment, guys. So that's all I've got for now.
Much appreciated. Thank you so much, Terry. Excellent work as always. Yeah, I loved the fact that right as the XLE was starting that hook there on the weekly, we were seeing the move out of that possible wave 4. We had that 5 up, 3 back, good confirmation progression for the move higher in, of course, crude oil and energy. All right, Mr. Alex, sir, you ready to jump in? And if you guys are interested in cryptocurrency specific coverage, first of all, tomorrow morning, 9 a.m. right here on the Trading Analysis YouTube channel, we have Crypto Lab with Alex. But this afternoon at 3 p.m. Eastern, noon Pacific, we've got a Bitcoin webinar. And this is a webinar where we're going to take a look at Alex's view on Bitcoin going into this year, where he expects some of the major turning points to occur. If you've been following his work, you know his track record is incredible. It speaks for itself, not only identifying the $3,100 area lows, but picking the June 2019 high as well, and then of course calling the recent 65 and 70K highs as resistance for the correction. So, sir, we're going to get the screen share past your direction. How are you doing today?
Yeah, can you share, send me a share screen once more? It seems that it dropped off. Thanks.
Yeah, not a problem. Terry, can you grab that? I don't see it.
Yeah, I got that. Hang on a second.
Oh yeah, you got to cycle.
Go back to me, and then go back to here. Here it comes.
Yeah. Here. Thanks.
Perfect.
Yeah. So yeah, looking forward to that webinar. You will be with me co-hosting it. So it's going to be a very interesting deep dive in fundamental and technicals of Bitcoin and what we see in 2022, 23. So I think it's going to be useful for many, either short-term, swing-term, or position or investment Bitcoin timeframe. So guys, hop in. It's free, it's public, it's lots of information, lots of, I think, valuable stuff from Bennett and I in regards of technicals. Yeah, so let's dive into a little bit of macro.
Absolutely, and if you guys want to sign up for that right now, tradinganalysis.com/webinar, you can get signed up. Again, that's going to be 3 p.m. Eastern, noon Pacific. All right, Alex, you ready?
Yeah, let's go.
All right, take it away. We'll be back on the other side to wrap up.
Hey guys, as usual, let's dive a little bit into the current outlook on the 10-year yields. As we were looking before, we have seen almost 2% target reached. If this is a triangle or something else in this respect, yeah, I still looking this as a 5-wave sequence. We can actually put a triangle here. But for now, I will keep it like this. I guess as I see a possible COVID kind of a ease off, many countries are seeing this as something that actually is going to be the last variant, and potentially this supply side can ease off. We might see a little bit of a break up here and then reversal on the downside. Fed meeting is on March. 0.25 basis hike is generally good to go. They're gonna exit the QE, but I don't see that inflation scare is going to be so big in 2022, especially if we see a balancing economy. It will take some time for the economy to balance, but I guess it will take time. It's not going to be it's not going to be that easy. Let's look what is going on the European front. Terry, can you just click cancel? I cannot do on this GoToMeeting because this pops up. It seems to me that I pressed accidentally leave or end meeting, so I cannot cancel it out. Can you just do it for me, please? Okay. Yeah, still I cannot change the charts because
there should be an X in the upper right hand corner of that pop out. Or
no, it doesn't work.
Okay, I'm not sure.
Yeah, maybe Terry can do it. I don't know. I can't.
All right, try it again, Alex.
Yeah, I cannot press anything here.
You can't
I don't
share
know
the screen back?
Yeah. Let me try something. Yeah, sorry guys, just a little bit of technical issue. I don't know. It looks like frozen, but it doesn't work.
All right, no worries. Just all the more reason for everybody to join you tomorrow morning, 9 a.m., right here on the Trading Analysis YouTube channel for Crypto Lab. We do apologize having some technical difficulties this morning, but if you're interested in a little taste of Alex, please join us for the webinar this afternoon. It's going to be a great time. Again, tradinganalysis.com/webinar. Alex, any commentary you want to add on yields or minus the charts? You're more than welcome to.
Yeah, in general, I think inflation will ease off in 2022, beginning of 2023. We should see a slowdown. In regards of dollar index, we still stay bullish either in the current 5 waves move on the upside or in possible ending diagonal if we see a break of the support levels. And on metals, we pretty much stay the same. I think triangle in gold is still on. And this a little bit pop up in silver still doesn't reflect a 5 wave move on the upside. So in that respect, charts are pretty much same as the last week. This wave count works pretty nice so far. And on the Bitcoin, we are going to do the webinar. So please join us again, www.tradinganalysis.com/webinars. And we're going to go into a deep dive, fundamental and technical analysis and what is next in 2022-23. So please join us. I think you will enjoy it.
Absolutely. And if you guys are interested in test driving the cryptocurrency service here at Trading Analysis, we're going to have a special offer included in that webinar as well. Excellent work, team. Yeah, regarding Bitcoin, or excuse me, regarding gold, we continue to view that as E of the wave 4 triangle. We've got a good clustering of support. We've got a good pairing of the dollar chart to gold in terms of the outlook moving forward. So he'll touch on that a little bit more tomorrow, and we'll see you guys hopefully in the webinar this afternoon. Members, we'll see you in about 15 minutes for our webinar, and we'll go from there. We'll be back, same time, same place next week. Terry, Alex,
all right, thumbs
appreciate it, gentlemen. Be safe.
Yeah, see you guys.
All right, we'll see you guys next week. Take care, members. Take care, traders, investors. We hope members. See you on the next one.